Adrian, hi, morning. How are you feeling about Indian equities? We've all seen the kind of weakness that we've gone through testing the 5,200 mark and, of course, the currency weakness as well. What's the call now on India?
Well, I think the call all goes back to the currency. If we look at the currency and we also look at the equity market, it is now statistically cheap, particularly within the equity market if you're looking at banks, materials and energy. And when we review the currency, it looks about 30% cheap versus its average real effective exchange rate. So there's definitely value there. The question, though, is can the RBI do enough to stem this type of rapid depreciation that we've seen in the rupee? And when you go back to the history of the Indian currency, this is the sharpest period of depreciation that we've ever experienced. And so reversing that is very important. And I think what was done yesterday with regards to the use of swap lines is constructive in helping that. But ultimately, I think the most important thing to do is to look at what's happening with the trade balance and the current account deficit. Now, the government estimates that they would like a deficit of 70 billion. We think it's probably more realistic to be 80 to 90 billion. However, when we look at trade data at the moment, it is suggesting that the current account deficit is narrowing quite quickly, and maybe a run rate of near a sort of 30 billion is being implied by the data, and that is obviously quite encouraging.
Adrian, as someone who's been monitoring India quite closely, although sitting outside, what do you think the RBI can do? Because part of the market also believes that this is not an India-related problem, but more to do with emerging market currencies. We've seen that happening in Turkey, Indonesia, and India is no different.
Yeah, but the RBI is doing exactly what they should do, which is allow the currency to depreciate. This makes them different from Indonesia, which has tried to protect particular levels on the currency. Your currency depreciates, your import bill will go down, your export bill will go up, and that's how you solve it. You let the markets do the work. So broadly, the RBI is doing the right thing.
Adrian, in the current environment, I guess it's very easy to make a bearish scenario for Indian equities. Rupee is the pain point, economic recovery will get delayed, earnings are unlikely to grow. But do you think all the bad news is in the price? Because the way markets operate is that they always tend to focus on future, never focus on the past.
Yes, look, as I said already, there are certain sectors in the Indian market that are looking statistically cheap. The currency looks cheap, so there clearly is value here. But value is not a catalyst for purchase of markets. What you need is confidence that the pace of rupee depreciation is going to slow. And, there is an argument with what happened yesterday that the RBI is coming up with measures that are more effective in that. This is a game of confidence. The currency is already oversold. The question is, how do you stem the direction as opposed to sort of the underlying fundamentals and value?
Adrian, Indian markets are extremely dependent on global flows. Now, the data in last 10 days, if I look at the FI data, is indicating that foreigners are now in a mood to reduce their exposure to India. Is that a big concern? Because India is still a very overowned market and nearly 20% of Indian markets is owned by, foreign investors.
Okay, well, let's think about that question, right? If we were in an environment where foreigners were buying, would we extrapolate the market constantly going up? I think the problem in this focus on flow data is flows actually tend to follow rather than lead market moves. You are correct that foreign investors are a significant part of this market. It doesn't make India unique. That is true for all markets. In the case of China, the H-share market is 100% owned by foreigners. There's no local participation in that. So the issue here is that the fundamentals and particularly the confidence around the currency. So if we can get some stability on the currency, then I think flows will reverse and the Indian equities will begin to rise once more. But they'll be led by the sectors that got punished the most in the sell-off. So it is going to be things like materials and banks. rather than consumer staples and the IT names, which still are good value, but they're not going to be the leaders in the market when the currency stabilizes.
Adrian, when you say banks, would you stick to the private banking lot, or do you find value now in some of the PSUs as well? Because some of the valuations are looking mouth-watering.
Okay, I mean, I can't specifically talk about stocks, but if you look at this generically, I would be taking money out of the higher quality private sector banks that have held up better. Would still be buying some of the private sector banks that maybe are more wholesale funded, so suffered in the decline, and also would look at some of the PSU banks, which are looking statistically very cheap. So it's sort of slightly lower quality, a little bit more PSU than private sector than people have been holding up till now.
Adrian, in the month of August, consumer staple stocks have also reversed. In fact, the BSE FMCG index is down by about 15% in the last 1 month. Do you think staples could correct some more because they are still expensive?
Well, I think there's a degree of that, but it's an interesting point you bring up. We've begun to see in the last couple of weeks the sell down of high quality names. This suggests a degree of capitulation going on in the market, and that often marks that we're closer to the lows. So I would suggest it's a good sign. But if this is a story, and this is a very big if, that the currency can stabilize around this level, maybe the sort of 66 to 68 range, maintain that for a few weeks, then I think it's going to be the sectors that have sold off the most in the last couple of months that probably do the best. It's interesting when you look at some of the material names, some of the steel companies, they clearly are winning domestic orders through import substitution. And it's often import substitution that's the first thing you see after currency weakness.
Adrian, what is it that you're feeling about the metals universe? Because they again have been the beaten down ones, although the rally has somewhat started in the last 2 weeks or so in the sector.
We do like the metals names, and we would highlight this idea of import substitution as being a key driver. So instead of importing steel, you buy steel off a local producer if you need to use steel in the Indian economy. And we're definitely seeing some positive trends going on there. So we like some of the steel names. It is possible that India will start exporting iron ore. It will make a lot of sense for their trade numbers, and that would help some of the mining names.
Adrian, what is your understanding about consumer demand in India? The consumer demand in India is robust, and since we have good monsoon this year, do you think consumer demand will remain strong? And if consumer demand will remain strong, is it still time to buy consumer dominated sectors like autos?
Well, I think there's a number of different trends going on. You're absolutely right. We've got a good monsoon. We have had some disruption, though, of food supply chains with onion prices going up, particularly in Maharashtra. But broadly, we should have good income growth in rural India. We have a food security bill being passed. We're obviously running into an election early next year. So we would expect rural spending to be relatively robust. I think specifically with regards to the autos, the problem for the autos is that interest rates, which had been declining earlier in this year, have reversed as the rupee has been weak. And so it's likely that the availability of auto financing will be poorer, and that is bad perhaps for both two- and four-wheeler demand. And we continue to have disruption in the two-wheeler market with Honda of Japan entering with their own facilities, and that's disrupting the listed two-wheeler plays.
What is your take on Indian energy space? The Indian energy space is perhaps interestingly positioned. PSU energy companies will lose because of rupee, but names like Reliance and Cain, they will gain because of a weak rupee.
Yeah, so I think we need to look at what the exposure is there. So we've had a significant depreciation in the Indian rupee. Companies with large capital assets have effectively got an appreciation in those assets, because if you needed to import that equipment in hard currencies, it would be very expensive. If you're selling into international markets, clearly you're a beneficiary. I think the problem for the domestic refining and marketing names is that both the diesel and the gasoline price is now being heavily subsidized once again, and that will put pressure on their balance sheets unless the government adjusts the price. And if they do adjust the price up, you would expect some sort of impact on demand, and so that could hit your top line. So I think it's the names that have already been outperforming in the energy space that are better off in this environment. And those that haven't been performing well have still got to deal with this policy issue of when will the government increase diesel and gasoline prices. And in the context of passing that food security bill, we've got a meaningful deterioration in the projected fiscal deficit. So they have to be quick in sorting out these subsidies.
Adrian, what about the capital goods / engineering space? Is there anything that you like out of there? Because with the assumption that perhaps consumption would pick up, or if not, India would turn to homegrown companies, these sectors or companies as well should be doing well.
Well, I don't think that's right. What we should be seeing here is actually a hit to demand for capital equipment on the back of the fact interest rates are higher. Economic uncertainty is built with the rupee weakness. So we were discussing earlier the sort of sectors that we do like would be the banks, some of the metal and mining stocks. That's where I'd be more tempted to go into rather than buying late cyclicals like the engineering companies. Now, if you'd asked me that question 3 months ago, I probably would have given you the opposite answer. But a lot has changed when the rupee's at 68 versus where it was 3 months ago.
What about pharmaceuticals? Because again, the story is very divided in that sector.
Look, pharma would have sat there to some extent with IT, with some of the other export earners, or deemed to have products that were defensive, that had some dollar link. So I would imagine defensives like pharma would underperform if we are beginning to see some currency stability. But again, this is a sector that we tend to like to group together. But each individual pharma stock has very different characteristics, different product profiles, and it does become much more of a stock selection issue rather than a style strategy issue.
Adrian, do you think the large cap IT trade is getting not crowded but extremely crowded? Just about every brokerage is bullish on it. Just about every fund house is now bullish on it. We had the vice chairman of Tech Mahindra on our show yesterday, and he acknowledged the fact that rupee is great, but that is a one-time windfall gain. The business dynamics haven't changed the way markets are pricing in.
Yeah, look, I think I'd answer this at two levels. Are these stocks expensive? No, they're not. They are going to benefit from positive earnings revisions. However, they have significantly outperformed the market. That's outperforming a rapidly declining market, remember. And that if, and this again, this big if the currency is now going to stabilize, I do not believe that IT services will be a sector that's outperforming in the recovery rally. I think you're better off in the banks and some of the material names.
Adrian, final question. If you have to make a pecking order for emerging markets and Asian markets, where does India stand?
Okay, and this comes back to this currency question. If the currency is stabilizing, then I think India is very interesting at this point in time. It looks better than Indonesia because the Indonesians have not allowed the currency to depreciate like it needs to. So within the current account deficit markets, my preference is India over markets such as Indonesia.
Adrian, always a delight to have you back on ET Now, and thank you for your robust and fantastic views.